Coming up on Market to Market. Midwest renewable energy efforts step into the spotlight. Tighter supplies bump the commodity markets higher. And the effect of stricter rules on those investing in the farm's bounty. Those stories and market analysis with Darin Newsom next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, May 13 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Spring appears to have finally pushed away the last vestiges of the winter blues as consumers parted with a little more of their hard-earned cash. Commerce Department data shows the Producer Price Index added 0.2% last month as wholesalers ramped up production. The more focused core PPI, calculated without volatile factors like food and fuel, moved 0.1% higher. Consumers seemed more than happy to take those new goods off the shelves as retail sales bumped up 1.3% in April. When auto sales are taken out of the equation, retail sales moved 0.8% higher. Even with the economic engine revving up, everyone is still searching for more economical ways to keep the lights on, both literally and figuratively. At the helm of the literal development is the Department of Energy. To satisfy the requirements of their never-ending quest for cheaper, more efficient, and cleaner sources of power, the agency's leader has been crisscrossing the country to glean new ideas. John Torpy reports.
I want to make one simple point first.
United States Secretary of Energy Ernest Moniz has been on a fact-finding mission for the past few weeks to gather input from energy industry leaders, government officials, and the public, all of whom must handle the task of jumping the challenging hurdles for the next generation of energy creation. Strengthening and improving electrical delivery systems and navigating the finer points of implementing new energy production, including renewables, were at the top of the Secretary's agenda. Moniz took time to talk about an all-of-the-above approach that included a popular plains-based biofuel.
We can get even significantly lower as we can drive down the costs of the next generation to use things like corn stover agricultural waste. So that's one area that is, I think, extremely important.
For many electrical cooperatives, solar and wind power have become assets despite the potentially high cost per kilowatt hour. Providers can now guarantee, when the customers request it, that a certain percentage of the electricity they consume comes from renewable sources. And government officials are quick to point out that working partnerships are the best means of improving energy delivery in rural areas.
It's expensive to deliver electricity across places where there's not a lot of people. And so that's something that we see rural electric cooperatives, who are some of our biggest partners in economic development, working it out with an increasing number of producers and businesses who are making those renewable investments, but that will be a process over time.
Of this laboratory,
Secretary Moniz also attended the ribbon-cutting ceremony for a state-of-the-art laboratory at Iowa State University. The Department of Energy provided $10 million to build the Sensitive Instrument Facility at the Ames Laboratory in Ames, Iowa. One item on the lab's to-do list is creating new composite materials for the next generation of wind turbine blades.
Going to higher hub heights and bigger turbines, that would certainly help a lot other parts of the country, like the Southeast, but it could also be important here in the Plains region.
For Market to Market, I'm John Torpy.
Merger rumors are swirling around agricultural giant Monsanto. The suitors include German agribusiness companies Bayer and BASF. If one of the companies wins the battle, the merger will still need a U.S. government blessing. Third-party oversight also is a mainstay of policy on LaSalle Street. The Commodity Futures Trading Commission and the National Futures Association watch everything from commodity trading to appropriate floor conduct. And while the NFA is self-regulating, it is legally bound to follow federal law. Despite the watchdogs, fraud still occurs. When it does, the government tries to close those exploited loopholes. Occasionally, the new rules have unintended consequences. Colleen Bradford-Krantz explains.
Minnesota farmer Dean Toftlin remembers how an October 2011 radio report first told him that brokerage firm MF Global Incorporated was in financial trouble. Although he knew his commodity broker worked with MF Global, Toftlin was confident that the nation's regulatory system would ensure his money was safe. But within days, Toftlin's account was frozen. He couldn't access the $253,000 he'd earned from his own corn and soybean investments.
I remember going onto the website and trying to access my funds, and it was just shut down. So it's like, it's kind of a weird feeling to see. One day it's there, you trust it like a bank, and then the next day it's, inaccessible.
Ultimately, more than 38,000 customers were affected when their segregated accounts were raided by MF Global officials as the company headed for bankruptcy. Farmers and other investors ended up being out more than $1.6 billion. Although Toftlin and others have since been reimbursed for nearly all their missing money, the case, and ones like it, shook confidence in the financial markets. Congress, reacting to the Great Recession, had already passed the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010, and work had begun on the required changes. 5 years after MF Global, members of Congress are still debating whether the law produced the desired effect.
For too many end users, Dodd-Frank has created more complicated and more intrusive and more costly regulatory mandates that force hedgers to choose between paying more to manage their risk or risking more to manage their cash. This is not what Congress intended when it enacted Dodd-Frank.
The Commodity Futures Trading Commission, or CFTC, the federal agency that oversees futures and options markets, is tasked with fulfilling many of Dodd-Frank's requirements. The agency is nearly 3 years overdue for reauthorization by Congress.
I'm pleased to be back.
Timothy Massid, the agency's chairman, testified before the House Agriculture Committee in February about recent and upcoming regulatory changes.
We're now making sure those rules work as intended, which includes making adjustments and fine-tuning them where necessary. In particular, we are working to make sure they do not improperly burden the American farmers, ranchers, and businesses who did not cause the crisis.
Brokers and farmers say the effects of the new rules are being felt throughout the nation. For brokers and grain elevator operators, the rules typically mean spending more time and money on recording, digitizing, and reporting information about investment practices. Pending regulatory steps may require grain merchandisers to preserve text and phone calls in a searchable digital form. Greg Dowd with the Commodity Markets Council, a trade association for the commodity futures exchanges and their participants, said swaps trading was the intended focus of Dodd-Frank, not commodity hedging.
If this continues, we are very concerned that there's going to be a problem with our ability to offer the types of contracts, forward contracts, et cetera, that we offer to farmers today if these are not or no longer qualified as bona fide hedging, but considered speculation.
For farmers who hedge to manage risk associated with changing commodity cash prices, the new rules mean settling margin calls by transferring money overnight rather than sending a check in the mail. Minnesota commodity broker Pat Von Tersch accepts the changes as a way to ensure investor money is safe and trust remains high.
We've had to deal with a little extra compliance and regulatory measures as a result of all of that. I guess I would argue it's well worth it. The only other comment that I would make to that is that it's, MF Global was the problem, so to make, increased regulations for the producer community or the retail community is a little bit frustrating, I suppose.
In recent years, the number of commodity brokers and brokerage firms has slid as many have sold out or closed, a trend experts believe may have been accelerated by the increased cost associated with new regulatory requirements. The number of registered individual brokers has dropped nearly 20% in 5 years, and the number of commodity brokerage firms declined 45%. At the same time, new international banking regulations related to capital requirements simultaneously threaten to unintentionally make commodity trading more difficult.
That has led to a situation where very large international trading houses have been rejected by some of these banks, saying that you have disrupted our bank's ability to do business because our leverage ratio is now out of proportion. It could lead to up to a 3-fold increase in what a farmer or a co-op is required to have in their margin account in order to continue to conduct business and trade.
The government's CFTC has, since 1974, been responsible for policing the futures markets to ensure the industry's integrity. The National Futures Association, a self-regulating professional organization established in 1982 under federal law, has rules in place that its members must follow or face fines and expulsion. Dowd says the two entities are facing a difficult challenge when trying to prevent fraud.
You can't write a regulation or write a law that accounts for every single possible contingency in the market. The exchanges, the NFA, and ultimately the CFTC are dealing not only domestically but also internationally in a marketplace where we can move billions of dollars around the world with a click of a mouse.
Von Tersch said he feels confident that the CFTC and the NFA are sincere in trying to minimize the impact on farmers and grain merchandisers.
But as this legislation is enacted, again, it probably has created another layer or two of compliance that has gone over the top.
Dowd said it's possible to create more market uncertainty by making futures trading more costly and difficult.
If these regulations do not work together well or do not allow these companies to lay off and manage their risk, they have the potential to actually create risk where it didn't exist before.
Toftland, who testified before the Senate Agriculture Committee in December 2011 about the impact of MF Global on his operation, appreciates the attention paid to preventing another such scandal. However, he also wonders if federal authorities may have overreacted with some regulatory changes.
The tendency of anything like that is maybe the pendulum is maybe swinging too far to the other side. So maybe we need to slow that pendulum to have a little less regulation because we want to make things affordable at the same time. But I think they've come a long way.
For Market to Market, I'm Colleen Bradford-Krantz.
Next, the Market to Market Report.
Tighter supplies had more of an impact on the commodity markets than weather or political conditions in South America. For the week, the July wheat contract added 11 cents, and the nearby corn contract gained 13 cents. The May WASDE revealed tighter supplies and fewer South American soybean acres. The news pushed the July contract more than 60 cents higher. Profit-taking pulled the price back by Friday to still post a 30-cent gain for the week. July meal followed along, adding $20 per ton. In the South, the July cotton contract continued to wilt, falling $1.30 per hundredweight. Over in the dairy parlor, June Class 3 milk futures continued a 4-week slide, slipping 66 cents for the week. The livestock sector finished mixed as the June cattle contract jumped $2.69, August feeders cut 93 cents, and the June lean hog contract added 67 cents. In the currency markets, the U.S. dollar index gained 71 basis points. The June crude oil contract moved $1.55 per barrel higher. A contributing factor was a falling rig count that hit levels not seen since late 2009. June COMEX gold lost $21.30 per ounce, and the Goldman Sachs Commodity Index gained nearly 10 points, finishing the week at $359.30. Here now to lend us his insight on these and other trends is one of our regular market analysts, Darin Newsom. Darin, welcome back.
Thank you, Mike.
We are excited to have you here on the heels of a big USDA report, Darin Newsom.
Oh, yes.
How much stock did you put in Tuesday's report?
None. It's just another report. It's billed as USDA's initial look at new crop. It's the third initial look at new crop that we've had. We got to go back to the annual outlook forum. Then everybody, we sat around here at a panel discussion. Everybody made up their own supply and demand tables following the March 31st prospective plantings report. So we've seen the numbers, and all this one is a combination of those two. It takes the acreage numbers from prospective plantings and basically uses yield numbers from the annual outlook. Then you're going to start adjusting some demand.
Okay.
Other than that, really, and the way the markets reacted, I think, were the highlight of this, basically ignoring completely what USDA had to say. That was the charge that I got out of this.
Okay, and let's talk about the wheat market. We're up 11 cents on the week. Tell us your thoughts.
Yeah, why? Why is wheat higher? We're supposed to have over 1 billion bushels in this new crop, ending stocks. Ending stocks use of almost 50%. World ending stocks are going up as well. Wheat rallied this week. We recently had the Kansas Quality Tour go out and find an enormous crop out there that has survived everything we could throw at it. Market doesn't care anymore. Doesn't care about all these numbers. I have no idea why wheat rallied. There's no weather threat. U.S. dollar was up and wheat still rallied. It could be everyone's just tired of selling it at this point. Now, is it going to keep going higher? Impossible to tell when it does this sort of move, but the charts are looking better.
Okay.
This looks to be a chart-related move. Haven't seen anything on the monthly charts yet, but the weekly charts are looking a lot better. Very hard to imagine if this is all, if the size of the crop is what the Wheat Quality Tour said as it is, if ending stocks are anywhere close to right, which, who knows, they may or may not be, there's no reason for wheat to be rallying. But it did anyway.
Okay. Given that there's no real reason, even though the charts are starting to look a little favorable, do you want to be a seller in here, or do you want to watch those charts and see if we can take this thing a little higher?
See, wheat's different than corn and soybeans. You can't go out and say, you need to be selling all this wheat up front, because the crop may look good now, gets one hailstorm, and all of a sudden you go from making 50 bushels the acre to 0 or 10 or whatever it might be. So I've found over the years it's very difficult to get more than 30%, 33% forward contracted at wheat any given time.
Okay.
I wouldn't do it yet because the market just looks like it's getting ready to take off.
Okay.
But if we get a bit of a pop in here, you may want to pull the trigger on a little bit, and that might bring us closer to harvest. We know a little bit better what we're going to have.
Well, and we're getting close. That kind of leads us right in. We got a question from one of our followers on Twitter. This is from Doug in Moses Lake, Washington. He's asking, can we see $5 on July Kansas City wheat again?
Absolutely.
Will we see $5 on July Kansas City wheat?
The 2017 contract's already there. 2016 is sitting closer to 4.5. Could we see that one get to 5? It's going to take something miraculous, really, or out of the ordinary. Let me put it that way. Maybe the dollar starts coming back down again. We got that economic news out today. Certainly helped bolster the U.S. dollar index a little bit. Bringing up the idea again that we're going to see the Fed make a move in June. If everything calms down, if markets calm down, dollar keeps going up, weather's fine over much of the southern plains and the rest of the wheat growing area, it's going to be more difficult for wheat to get to 5. But anything happens. Anything can happen. And if buyers continue to come into this market, if investors continue to come back, yeah, we could try to push the new crop or the July 16 up close to 5.
Okay, well, let's talk about this corn market. Another move higher on the week despite USDA. What are your charts telling you? Can we continue to climb this market?
We're right up against the high side of its trading range that we've seen now going back, year and a half. So while all the momentum looks like we should be able to push through, it's very hard for people to see the logic as to why. Okay, we're going to have 2.1. Supposedly we're going to have 2.1 billion bushels ending stocks. Absolutely nothing bullish about that at all. Market's doesn't believe it. Maybe we're not going to have the 93.6 million acres or whatever it was. Maybe yield's not actually 168. But for whatever reason, market continues to go up. If we can pop through that top side, and if money starts to come in a little faster, then I think it does open the door for this market to keep running here spring into early summer.
Now, popping through that top side, are you looking on the nearby at the 405 level? What is the top side?
You know, it's right in that. It's near that. I wish I looked at my chart a little closer before I came in, but it's right near that. Right near that 410 that we saw. And so if we can get through that, and right now we'd be looking at the July, but in the December as well, if we can just continue to build some momentum. We saw a nice week this week. You know, we were actually able to post a new weekly high here on Friday. And that's usually a good sign. If we can keep this momentum going, yeah, I think we've got some room to run this market. However, next week's a whole new animal. No USDA report, no nothing. Could start to put some weight on it again.
Okay. The market that really kind of caught everybody I've talked to by surprise this week is soybeans. Limit up on Tuesday with the USDA report, then it trailed off a little bit. Does that have legs? Are we in a new environment here in beans?
Why was anybody surprised, is my question. Why was anybody surprised by this? We've had future spreads, and we've talked about it countless times. We've had future spreads showing no carry in the market. The market's been telling us for a long time, beans aren't there. Either the U.S. beans aren't there, South American beans aren't there, or demand is a lot larger than what's expected. And that seems to be what's played out. I mean, for new crop, USDA trimmed its they took 130 million bushel, something like that, off of its outlook forum number of 440, came in at 305, you know, for new crop soybeans. And that's using the same rule that they usually still underestimate demand. So are we actually looking at a possibility of 200 million? We've got an inverted Nov to Jan future spread right now. There's only one reason why it'd be inverted. Market thinks we're tight on soybeans. Doesn't care if it's 300, 400, 500. Market thinks we're tight.
Given that we are inverted currently, and we do believe there is a big crop in South America, how aggressive do you want to be on making those new crop sales in an inverted market environment?
Two of the most bullish charts that I look at are the monthly chart for soybean futures and the monthly chart for the cash, DTN National Soybean Index. These turned bullish at the end of March and posted some bullish long-term signals. I wouldn't be overly aggressive right now. You've got bullish future spreads, you've got bullish spreads themselves, or bullish futures themselves. I'd sit back. You know, now if you like the price, you know, we're getting over $10 or whatever, getting close to 10, take it. By all means. It just looks like the market may have some room to run in here.
All right, well, let's talk livestock. We did see this market run a little bit on the live cattle side, up 263 on the week. Demand coming back in. Where do you see the cattle market moving?
Again, I like, you know, I'll go back to our discussion on April 1. I know but it's like everything else. I know the fundamentals are bearish. I know the herd size is getting larger. Demand is keeping up at this point. We've got very impressive charts, impressive monthly chart. After we posted a new April low, we were able to bounce back. Looks like we've got a 2-month reversal going on in here. We had a bullish gap left on the weekly chart for the June contract. We've got the June-August spread showing a very bullish short-term supply and demand situation. To me, I think cattle are going to move higher. You know, fundamentally, I can't tell you why. But it looks like futures want to go higher. Futures spreads showing the cash market should go higher. I think we're going to see. at least the next couple of weeks look pretty good in the cattle market.
Pretty good. $10?
I think so.
$20?
Closed at 123, around the 123 area. Look at the weekly chart for June. Initial resistance between 125, 130. Then you go up to 135 if it really gets rolling. I'd be comfortable saying, yeah, we should see 130 here relatively soon. Can it push up to 135? Sure it could. Sure it could. If it really gets moving, it could.
Feeder cattle off a little bit on the week. Where do you see feeder cattle moving?
Not that much different than the live. You know, and this is one of the things that might be telling me maybe corn's run up against its top side and might pull back a little bit because the feeders look pretty good actually. Its initial target's up around 155 on the August contract. So, you know, may have a little bit, it may lag live cattle a little bit as far as activity goes. But I think we're going to go ahead and see the feeder cattle push higher as well.
Is there enough strength that even if corn should begin to put a little more steam on this thing, feeder cattle could still see a rise?
We saw wheat and crude oil rally with a stronger U.S. dollar index, so anything's possible. We may see feeder cattle and corn go skipping down the lane hand in hand to higher prices. I have no idea. It's not out of the realm of possibility.
Lean hogs up 67 cents. Hogs still up in the 80s on the nearby. Where can we go from here?
You know, I'm still not as bullish hogs. They're holding together really well. Demand's looking really good right now for hogs. Future spreads aren't as bullish as they are in the cattle market, but I still think the cash market wants to stay strong. So while I'm not quite as bullish as I am, say, on the two cattle markets, I still think lean hogs could look a little bit better over the next couple weeks.
Couple dollars, is that kind of what we're looking at?
I think you're going to see a lot of choppiness, and that brings up, you know, the one thing we have to remember in these cattle markets, in these livestock markets as a whole, is incredibly high volatility. I mean, we've got very volatile, particularly live cattle, but it's leaked over into feeder cattle and lean hogs to a certain degree. So, you know, anything is possible. Continue to see, you know, $2, $3 move up, immediately come back $2, $3, and then just keep stair-stepping all over the place. So do not be surprised if that's the same pattern that we see over, you know, the months ahead. Okay.
Now, you talked about the U.S. dollar being a little higher on the week. Crude and wheat still climbing. Where does the dollar go from here?
I still think it's going down.
Okay.
I'm not convinced that the economic data that we've seen, you mentioned what was it, producer prices and consumer sentiment and these sorts of things all were a little bit bullish for the dollar here this last week. My long-term charts still say we're in a downtrend.
Okay.
The monthly charts still say we're in a downtrend. I think we're going to go lower. I think it's telling us not going to see a Fed move in June.
All right. Well, Darin Newsom, thank you so much for taking the time to join us.
Anytime, Mike.
That wraps up the broadcast portion of Market to Market, but Darin and I will keep the market discussion going and answer more of your questions during Market Plus, available on our website. While you're there, let Market to Market Classroom take you to school. You're never too old to discover a new angle on the business, technology, and science of agriculture. And join us again next week when we'll examine how one man's mission to restore tractors became a family affair. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company. Offering a full line of grain drying and storage equipment and steel buildings, Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.